Hello, everybody. My name is Daniel Young. I am the owner and founder of Adaptive Perspective. I believe it's my purpose, my calling, to help you identify your dreams and help you reach your financial freedom destination and maintain it so that you can pass your wealth off to the next generation. This video, I'll continue to show you what I'm offering in our closed-end fund master. Information, the consolidation of that information, the consolidation of data, the funds we own, and how we filter all the data, and then recommendations based on the filtered data. Reminders, it's an unedited video, so who knows what you'll hear in the background as I film these in my house. I'll be going over our financial investment strategy of using closed-end funds instead of investing in single entity stocks. I'll demonstrate how we filter the data and then offer some targets based on what we currently own, and maybe offer a suggestion on where to start if you don't currently own a closed-end fund. So the disclaimers: I'm not a financial advisor. I am a financial strategist. The information contained in the video is provided on an as-is basis and does not represent personalized investment advice. The information is from sources believed reliable, but no guarantee or warranty is made as to its accuracy. I may be invested in some of the closed-end funds recommended or reviewed in the video. Transparency, the ones we own are colored in blue. I assume no liability for your use of the information contained herein, and encourage you to educate yourself on the market, to consult with a licensed professional, and to know your goals before investing in anything. And though I encourage you to talk with a licensed professional to get their advice, quite honestly, because I have to say that, I also encourage you not to be afraid to walk your own path. I don't talk like the herd. I walk in limited company, and sometimes I walk alone, and I'm okay with that. So let's get to sorting some closed-end funds for the day after June 19th. So let's see. All right. So here is the closed-end fund master. It is a list of 438 closed-end funds who still have an average of just under 9%, which means some pay none and some pay a lot. Everything in purple is recommended by people I read. The things in light blue are what we own. This heading at the top is kind of how I color code the whole system. So it's a ton of info. So let's get to sorting. So I update this every weekend, and then I do a complete, so I update these targets every weekend, and then I do a full system update at the end of every month. So let's sort these. No, move that a little bit. So if we just looked at solely at the discount, this fund, well, we'll get to that in a little bit. So I put everything by target. There actually is an orange one, which we'll get to. We're going to go down to here. There's interesting how these don't automatically copy one to the next now. All right, so targets. First, we'll sort by discount. So we're not going to pay premium, so we can take these out. Oop, that one too. GER is liquidating. So it's an orange. It's closing, but hasn't closed yet. All of these, I have no plans for us to add anything new. So the easier way might be this way. And if you don't currently own a closed-end fund, there are a couple that we own that would be great starting points. Oop, I deleted too many. Wonderful. That's what you get for a raw video. Okay. The DMA we need to keep because we need to chat about that a little bit. All right. So the two asterisks. Oh, no, we're still sorting. We'll leave that in. The two asterisks are dollar cost averages for us. Like they're cheaper buys than what we bought them at. And I know that because I track all our funds here. So IGR, our average price, $6.99, compared with currently $5.35. It would be less than our average. So it's a great dollar cost average. But we're not going to get into that. So if we sorted things just based on the discount, I always do this. So DMA pops first, right? And it would pop first in the master itself. But, and the reason why I don't want to keep it. So yeah, it's been around about a year. Um, Variable dividend, an ever increasing discount. And of all the different people I read, nobody's mentioned it. So even though it's got the largest discount, it's not going to make the cut. The second largest discount goes to this company. And I've heard it discussed in the past, but not recently. If we didn't already own several category threes, it would be something good to keep on our list. But since we already own three category three payers, really don't want to add any more. But just based on the data, so on a 5-year spread, it's slightly above the 5-year discount. On a historical data spread, it's a buy. It is for sure a lot higher or a lot greater discount than its historical net asset value. These others, I don't want an annual payer. And FSCO has mixed data. So say it's been around less than a year, depending on the site, has different dividend info. And same thing, none of the people I read have talked about this fund versus NBXG. Same thing, it's been around about a year, right? So it's close to its overall 1-year discount. It's heavy on tech infrastructure. It's got this really nice broad-based approach to 5G, but it's also got a really consistent dividend. It's paid this dividend since it opened. Not the same for FSCO. And then of the funds we own, that's first on the list, or at least first on the list for us. So let's go back to this list. So DMA, yes, largest discount, but is not going to make the cut. And as I talk to my family today, talk to my wife and daughter about how to best sort all of this data, I think the biggest thing we look at is the discount, but it's not exactly based on the biggest discount. It's based on the discount in relation to the historical data. So we look at discount. We don't pay premium. After that, we can filter it down to yield, right? And we've been operating with the mindset of working at a 9% or greater yield, which sounds ambitious if you're unfamiliar to closed-end funds. But if you're very familiar with closed-end funds, you'll find out that it's not ambitious at all. So on the break, so KMF, rumor has it, will merge with its sister company, KYN. MCI recommended, but not on our list. We don't want to add more. I'll put it that way. AOD, not happy with its overall performance. AGD, we inherited. It bought out a company we were invested in. FEI is due for a dividend increase. It's held the same consistent dividend since the lockdown. The price has come up. It's due for a dividend increase. But at the same time of where it is now and where we could invest our money right now, we can invest it and get a much better dividend than this. So, and since we're not going to keep DNIF, we're going to take these off. And then it comes down to price. And let's rank these again. Excuse me. A to Z. We look at our targets. So NML is higher than what we bought it for. Pays it an amazing dividend. But for us, I don't want to raise our overall average price. Cuba has not managed their funds well. Based on what I've read this weekend, they have over 32 million in assets, and it's all in cash. The fund has liquidated everything. It still operates. It still pays dividends on a automatic drip system or a dividend reinvestment program system where they send me a dividend, and then they take the dividend back and hand me shares. Yeah, not happy. And then DMA we've already talked about. So what's left? We don't want to add anything new. So then it comes down to all of these are great options. Now, HFRO still has the greatest discount. It's not like based on the 5-year average. It's higher than the 5-year average, but it's not double the 5-year average. If you look at the history of the fund, it's double the overall discount for the history of the fund. They're also in buyback mode. HGLB, it's been around for about 3 years. It's close to the 3-year discount, but it's not anything crazy. So I like the fund, but I would take it off. NBXG, technology fund. For us, is above our existing buy price. Let's see, NBXG. So we're almost $1 higher than where we are, which we would still, yeah, we would raise our average. It's still well above the average, but still, if we're going to dollar cost average, the goal is to not buy higher. GLO and ZTR are like 2-year bounce patterns or swing patterns. They do great for 2 years and then they reset a little bit, and they do great for 2 years, reset, and then it's like a bell curve almost. So if you can buy them low, that's great. And then you beware the swing, meaning like you buy them low, you watch it ascend, you keep getting a dividend as it ascends. So you buy it low, watch the ascension. About 1.5 years after you buy it, earmark it, sell it, collect the profit. It'll come back down. Same thing. Buy low, Okay. Or you hold it, like if you're going to hold it long term and you're not scared about the drop, you can collect the dividend the whole time, right? And then just buy more as it goes lower. So you can swing, essentially, you can swing your money. Or you play the moonshot, I guess, as somebody calls it. So it's, you buy it low, come up, sell it, reinvest the money somewhere else. It'll drop back down, equal to or lower. Then you buy the low, right? Wait for it to go back up, sell it again, right? Or you keep it and then you buy it low. HQL is uh, has a buyback program ending soon. Based on overall data, it's a good choice. KYN, I like it. Um, based on 5 years, it's iffy. Based on the whole historical data, it's a nice grab right now. HGY's technology, excuse me, and semiconductors, uh, it's a nice, it's a nice pickup right now. These are heavy in preferreds. Um, they're heavy on bank investments. They're not as low as they have been, but they're down in value, as is ZTR. FGB's come up almost 40 cents in the last 2 weeks, which is all private equity. So, how to break down the data, like how to pick the best thing. I think we start at discount. One, we look at discount and see who has the better deal based on discount. All of these have great buys based on the overall discount. Well, what now? Well, we can sort it based on overall yield. We can also sort it based on price, and then we can sort it based on what you already own. Uh, for us, I've been trying to build all of the shares we're keeping long term to 200 or more, and all the stuff that we want to sell to keeping that to 100 or less. Let's see. So, of the best deal, the biggest discount is still HFRO. And I am undecided on keeping it long term. It based on what's in the portfolio, it's built well. It comes well recommended from other advisors. I don't like how the company runs things on the investor side of things. On the back end, it sounds like it's run really well. But from what I can see from a shareholder perspective, it's not doing things with great PR. The name of the fund has changed without input. It's offered to buy back shares, which is great, but without input. Um, yeah, yeah. I'll leave it at that. Um, GLO is that moonshot. HQL is health, oil and natural gas. So what we would do if we were going to invest in anything right now, we would either A, buy here or here. Would either buy there or nope, not current. And that's not graded based on company performance. That's just graded on what we would buy if we were buying something tomorrow. Um, all of those original 8 companies, whatever it was, all of them are great buys right now. Um, if you're brand new to closed-end funds and you've never heard of any of this before, one, go back and watch my other videos. Two, do some independent reading. If you go to Facebook and you look for Adapted Perspective, Navigate Your Finances, that's my Facebook group page. And on that page, in the files section, you'll find a stock market terminology file, uh, or stock market terminology Word file. And it's got some basic info on different terminology, yes, like it says. But I also start talking about closed-end funds and comparing that to single stocks. So if you're completely unfamiliar with closed-end funds, learn some more and then figure out how you want to invest. If you want to invest at all, if you know about closed-end funds and you're looking to invest more, this is what we would invest in. And if you're brand new, you're looking for an idea of where to start, we own all of these funds. Um, yes, I've done all the research, I've compiled all the data. Those are my targets for those different reasons. But of those funds, if you want a fund it's kind of like an all-in-one bucket of things, ZTR is a great all-in-one bucket, but it's that bouncing moonshot of things. If you want something that'll pay you a monthly consistent dividend at great value, that's HFRO. The other one that I like to use as an example to stocks overall. Like if I'm going to compare something to, someone saying, "Hey, you should invest in Microsoft or American Tower or Coca-Cola or all of the above." The best example well, maybe not the best example. The example I tend to use the most is this one. So USA and what I'm working on right now, the next meme video I can kind of preview in here. We own this one fund called USA, and it holds these 12 different stocks plus a lot more. So USA will pay you a 9.5% yield as of now. The most you'll hope to gain with these other companies is just over 3%. Inflation is currently 4%. So if you're buying, say you buy American Tower, thinking it will go up, you're actually losing a little bit less than 1% a year on your money just by devaluation or inflation. So if it goes up a little bit over time, inflation will eat you versus this. MasterCard wants you to pay almost $380 for one share, and they're going to pay you less than 1% for owning the company. So inflation's 4%. You're going to lose almost 3.5% for owning this company every year. So if it goes up 10% in 5 years, you're losing so much more just based on the devaluation of the dollar because this dividend isn't paying you 4% or higher. So you could spend just on one share, you could spend almost $2,150 on one individual share of all of these things and get just $84 a year or a little bit under 2%. If we take this same amount, 2158, we'll even 2158.43 divided by The current price, there we go, divided by 6.31. Current price of USA is 342. So if we base it on whole shares, so if you're going to invest the same amount of money in all of these 12, right? But you could get access to them through one single closed-end fund. So you're going to spend the same amount of money, right? We're just buying one thing instead of all these other things. So that's 342. So you get $205 a year owning this one fund, which is still that 9.5% dividend, compared to the $84 a year you get for owning all of these crazy companies, which is less than a 2% dividend. Okay, and the crazy thing is, USA is amazing, right? It's a portfolio in a can. It's got everything in it, but it's not the best deal we have right now. And that's where you kind of have to know where you want to break things down. So the best deal right now is just based on discount and historical discount is HFRO, which is a fairly targeted investment. You're not going to get the same exact portfolio in a can per se. Like they've got several things, yes, but it's not as widespread as USA. So you kind of have to know what you want to do. Is USA a good deal right now? Yes, because we'll go back. It's at a discount, and it doesn't happen to be what's currently. Um, it's still a discount, but it's not. What I mean is, it's not worth. Say it's. I don't want to confuse you. There's currently a discount. If we look at the 5-year data, that's the average discount on the last 5 years. It does not hit discount very often. If we look at the last year, it's almost a complete switch. So we go on the year data, it's normally above, right? It's normally premium. You're paying more for it than it's worth. Currently, you're buying it for a little bit less than its total value. And even at that discount, it's a good deal based on how they manage the fund and based on what's in the fund. But for this purpose, it's not the best deal of what's currently out there. So if you want a place to start, like you're brand new, you have no idea what you're doing. One, you need to learn. Two, if you're looking for a place to start, consider this. Do some digging. Go to Google, type in USA Holdings Morningstar. And then you go to portfolio and it'll let you see the top 25. And if you dig a little bit, like type in USA Holdings or where are we? Liberty All-Star Equity Complete Holdings, it should show you everything. And for that meme video, I'm going to show everything on that video, but I've already showed the complete closed-end fund portfolio on different videos, right? But it'll tell you everything currently in the portfolio as of March 31st. And there's so much more there. It's amazing what is packed inside that one closed-end fund. But yeah, so if you want a place to start, this is a good place to start. Stop share. So those are my top selections for this week, plus a little more data. If you like the content, consider subscribing to my channel. And then also head over to Facebook and join my group there called Navigate Your Finances. And the link will be below. Facebook, I talk earned income and passive income and bridging the distance between the two. And then I talk portfolio income through our closed-end fund system on YouTube. And then if you want to see where I get the memes from for those meme videos, which I'll be That's that USA versus all of those other companies. That's housed on Pinterest. Same thing, search for adapt your perspective or adapted perspective, navigate your finances. All platforms have the same banner. Just makes it a little bit easier to distinguish me from other people. So as you go into the week, and really, regardless of where you go, remember that you're the captain of your ship. You have the power to change your life and your financial future. Many people will offer to help you, but only you can make the choice to do it. Make it happen. Shock your world. If it could have happened on its own, it would have already happened. If you want something to change, you're going to have to make a change, right? So make that change, make it happen, make it work, and then keep going on your journey. So this is Daniel Young signing off. I will see y'all on a different video. Bye-bye.